ticks away from that commercial sell zone, which doesn't make any sense. It's either or, but that's why we add value. If we add value, we can dismiss one of these two trades. We can dismiss some of these. That's a great question, Tim, because the answer is no, not really, because it's always a technical analysis, isn't it? But so it's very difficult to be perfectly defining what a double distribution is, because in terms of profile, it's just two high volume nodes with a low volume distribution in the middle. But we've been using technicals, and technicals come from a breakout of a liquidity level. So the idea of defining distributions is based on technicals. So what I mean by this is this. If this is price dropping, right? So we've came from a high price. What we were trying to show the guys, if you weren't in this morning, what we were showing the guys is that there's a technical level and a liquidity level on this chart. This is a technical level. This is what defines distributions, technicals. Because this is, if this price drops, that's a liquidity level here. So we would define this as a liquidity level here, and we would define this as a technical level here. So if that's a technical level, and this is liquidity, when it breaks that technical level, then it's moving distributions. The distribution's moving because it's broken the technical level. And when the price pulls back up to here, then obviously that new technical level is now defining this bracket here, isn't it? So we've now got what is now definitely a double distribution down. 100% double distribution down. And this becomes a technical level. Technical levels are liquidity levels as well, but we're just trying to make sure everybody understands a slight difference to allow us to think about the idea that technical levels, when you find people buying technical levels and selling technical levels are more important to us than simply just liquidity, because technical levels define the idea of structure. Liquidity is just liquidity, it's just a grab. So this is a double distribution down. So in the basis that this is a double distribution down, the only trade you've got is to sell. Sell, right? The only trade you've got is to be short, because this is a double distribution down. But if the double distribution down starts to fail at the technical levels, so if you remember how we would draw this in terms of our old-fashioned accumulation charts, and you start drawing these technical levels and you say, wait a second, every time we take out a tech level, the price gets bought. You're now thinking about this as an accumulation, right? But it might not be an accumulation. It might just be profit taking. So we're still selling this as locals, as prop desks. We're still selling the momentum on this. And what sometimes obviously happens as we break out this area, well, that's a technical level right here. Because now what we've done is we've broken this liquidity level. And when a liquidity level breaks and it holds, it becomes a technical level. Because initially this was liquidity, wasn't it? Because we were in a downtrend. So this was originally liquidity here. So this was liquidity. This was still liquidity at this point. This was still liquidity at this point. But when it breaks that price, then what they've done is they've turned this into a technical level. So this becomes a technical level right here now, doesn't it? Because it's now changed the behavior of the level, Tim, yeah? So because that's changed the behavior of the level, when you change it from defining it as liquidity to technical, this is now becoming a double distribution up. And if this is now becoming a double distribution up, you can now start buying this market. So when you've got a double distribution up and we get a price that does that, then what is this point here? Well, if this is now broken a technical level, then this is now the technical level here, correct? This is now the technical level here. So if that's the technical level, what is this? That's now your liquidity level. If this is now your liquidity level, you want to trade from liquidity to technical, don't you? So obviously your job now is to be momentum buying this for the time being. So it's that transition, Tim, that's the most important. See that transition there? That's what defines your double distribution. If you're not very good at defining that transition of behavior from buying to selling or selling to buying, that's when you're going to struggle, and you're going to be obviously relying on visually seeing more evidence of that change of behavior, for example. But that change of behavior can happen through things like deltas, seeing buyers at higher prices on the limit order book, seeing the deltas running out of steam on the sell side and becoming very bullish. Those types of things give you a lot of evidence about what that technical liquidity structure changes from and to. Because basically the liquidity, what they're using the liquidity for here, here and here, or here and here, is to get short. What they use the liquidity here to do is to get long, bigger size. They're marking up the price. So when they're starting to mark up the price, that is what causes the technical level to form, the markup. So the markup forms that causes the technical level to form, and that's when we start changing this from a sell to a buy trade. Does that answer your question, Tim? If anybody's still struggling with this, we're happy to do this in classroom again today, because it is an important point, because I think still a lot of people don't realize the value in this exercise. You know, the value in this exercise is getting away from fading tops and bottoms and being able to start recognizing. And it is subjective, guys. Unfortunately, everything in trading is pretty much subjective. How good you are is, if it wasn't subjective, it would just be a computer program and you wouldn't do any trading against it. You know what I mean? So on the basis that it's subjective, there's some people who see certain things that other people don't see, and that's what really, that's why you practice these things. That's why you go over it and over it and over it and over it and over again, to try and get your eye in, to start recognizing what is a good breakout zone. So if we go back to natural gas, for example, was that a good solid, would you have said that that moved from liquidity to technical here? Yes or no? Would you agree that that moved from liquidity, because that's obviously liquidity, right? So this is liquidity. At this point here, that's a liquidity level. So you're selling that. And obviously this was the technical level here, correct? That was the technical level there, because that's on the move down. So that's liquidity. So your job is to sell away from that pullback sell. So your job is to sell into that, correct? So what happened when we got that technical level? We got a level 2 buyer. So we got this level 2 buyer showing up here. So you're already concerned about the technical zone, because where's the technical zone now? Where's the technical zone now, guys? Technical zone now is that price there, right? So that's the new technical zone. That's still liquidity at this point. But it's only liquidity at this point. It's still liquidity. But you don't have to sell it, guys. If you look at that technical zone there, you're going to be thinking to yourself, should I sell this on the way up? Well, yes, if you get a lean and you start getting momentum. Did we get a lean and momentum to sell it, guys? Yes or no? Not a chance, right? Price went right through it. So we never got a lean. We never got any momentum selling. These are momentum sell trades. They're not fades. I don't put a sell limit order here and hope it sticks, especially when a level 2 buyer comes in at the bottom edge. So when it breaks this becomes a technical level, doesn't it? This becomes a tech because it's quite clearly broken it. And if that becomes a technical level here, now we've moved into a bullish market. If we've moved into a bullish market, what have we now established? We've now got a commercial buyer. So now at this stage, I can now highlight this area here and say, right guys, this is a commercial buyer. And obviously based on that narrative, now my only trade is to be a buyer. My only trade now is to buy gas until I change the distributions, or until I hit a commercial seller from a bigger time frame. So how's that going to happen? What are we going to be looking for? Well, we know higher highs are technicals, right? So there's a higher high there, so there was a technical there. There's a higher high there, so there's a technical there. There's a higher high here, so there's a technical there. And there's a higher high here, so there's a technical here. Does anybody see any problems with the technical structures? Does anybody see any anybody able to highlight any technical problems? Yeah, every single technical breakout, Melvin, is getting mugged by sellers, isn't it? Every single technical high is getting mugged into level 2 selling. So how aggressive are you going to be as a buyer at the bottom edge? Are you going to be buying quite happily at higher prices? Would you buy happily at higher prices, guys? Yes or no in that technical structure? Absolutely not, right? So when we see that technical, what is this level here? Liquidity. So what are you going to be doing? Well, think about it. If that's liquidity and that's technical, and that technical is a big distance higher than the previous technical, you're going to be buying gas, aren't you? You're going to buy gas in here, aren't you? You're going to maybe buy gas here. You're maybe going to buy gas here. You're going to be doing business here, buying. Would you agree with that? And when the price trades up here, you're going to take some profits. But you see, it doesn't break out. It doesn't break out. So when you start seeing a liquidity level here, you can still buy it, but you've got to be really cautious about that buy, because you're looking at the top edge and saying, I'll give it one more chance. Because obviously one more chance means that you've got 1, 2, 3 times a lead at the top edge. If it fails again, the chances of me buying that liquidity now is pretty close to zero. So what happens? Well, if this is a liquidity level and it breaks, what does this liquidity level become? If I wanted to, bearing in mind if I wanted to, what does this liquidity level become? A technical level, right? This liquidity level becomes a technical level because it's now broken out. And if a liquidity level becomes a technical level because it's reversed, a change of behavior, then what does this area become? This area becomes a possible commercial sell, okay? So if this is now a commercial sell, what is the only trade I can do? The only trade I can now do is sell pullbacks with momentum, right? So I start looking at selling pullbacks with momentum. So maybe selling in here, for example, because we've got a technical level here now, and now we've got a technical level here. So we've now got the technical levels driving the price down. And is the technical level good? That's all right. It's pretty strong. Pretty strong technicals. So when you hear that comment, pretty strong technicals, you're saying to yourself, pretty strong technicals. I want to be working the sell side of gas at the moment. But what I said to the guys this morning in class was, take a look at that chart. There's no attempt to try and buy a bottom edge, is there? There's no attempt to try and sell a top edge, is there? There's nobody trying to fade the up move or the down move. You're not trying to call the highs. You're not trying to call the lows. So when you come into this idea of a commercial buy here, you simply then say, well, that was the commercial buy in the background. You can go hindsight-wise and say, there's my commercial buy. When I see that liquidity changing to tech, you can then look at that and say, right, well, there was my commercial sell. And you can now draw that as a structure and say, there was my commercial sell setting up right there. Just see how it starts to show up? But what's common about the commercial buy and the commercial sell? The lack of progress against the previous technical structures. Do you see that? The lack of progress against the previous tech structure. So when we got that level 2 seller here, and then we got that level 2 seller here, that lack of progress against the technical structure is incredible. Just the same way as this lack of progress against that technical structure is incredible, right? So we can already start to recognize how incredible this process starts to evolve in terms of your knowledge. So obviously in terms of trade, the only trade I can do just now is sell this. So you might be agreeing that that's a good technical break. So when the price trades back to the technical and it fails to run through this area, you might decide to sell it back in here. There's a liquidity level there. And now there's now a new technical here. What happened to the new technical? Damn it. Somebody bought the tech at the bottom edge, didn't they? Somebody's bought the tech at the bottom edge. So are you going to sell right now? Are you going to start selling 73s? Of course you're not. Somebody's just bought the tech. Somebody bought the bottom edge, so why would you sell the 73s? So if I'm going to sell anything, I'm going to want some liquidity to sell down into that price to see if I can get a bit of space. I still need momentum, because now what I'm seeing is I'm seeing a technical level that's now getting bought, interestingly enough, at an area that we already know is a commercial buy zone in the background. Short term, of course, it's a 15-second chart, for God's sake, guys. This is a scalper's paradise, right? This is a scalper's paradise. So when we look at this, we're trying to fit our way into the story as it's evolving. I'm not trying to be a buyer at any stage. I'm just trying to make sure I understand how good the sell trade is. If the price breaks this technical level, that creates a double distribution down, which is now broken up. That should create a commercial buyer again. And then I change from selling scalps to buying scalps, selling locals to buying local. I become a buy-side local, a buy-side floor trader. I start using that change of technicals as my guide. Well, think about it. Technicals is the sentiment of the markets. You shouldn't be trading against the sentiment of the markets if you're a retail trader anyway, most of the time. Because if the market's trending higher, I want to be long the market as much as I possibly can do, right? But does this answer your question, Tim, in full? Does this answer everybody's question about these commercials and technicals and liquidity ideas? Technicals is the use of liquidity. Liquidity is the creation of liquidity. And the change of those from a liquidity area, which is the use of liquidity to continue in the direction of the trend, as opposed to reverse the trend, becomes a technical breakout level. It becomes a technical change of behavior level. And that changes to a distribution. That changes the distribution of the marketplace. And that's what we're trying to sense when we're seeing these things. A change of a technical level becomes a commercial. It's not as obvious in things like treasuries, but you'll all know that I was a buyer of bottom edge treasuries. I think I tweeted it. But anyway, we certainly touched on it in classroom. And guess what happened to my bonds? It did very well, thank you very much. This is how the trade evolved. Now, the trade obviously sold off the RGL last night. So what are these bottom edges? These are all technical bottom edges, right? So these are all technical bottom edges as we go down into this area. What happened at this technical bottom edge when we hit the volumes? Does anybody see a change in the technicals? Yes or no? Does anybody see a change in the technicals? It's crystal clear, isn't it? If this was a technical low here, and the price traded down here, that became the technical level here. When the price traded back through this technical, did it sell off? No. It cleaned right through that technical level. Cleared it. So there's a change in technicals, isn't there? The technicals have changed. So based on that rejection, that technical reversal right there, we're now thinking about the probability that this is now a bottom edge. We're now thinking about the probability that this is a commercial buy zone into this area now. So obviously when I'm looking at that, I'm thinking to myself, right, that's a commercial buy. So I start thinking about trying to pick up the long trade at the bottom edges. I did a tweet, I showed you that trade. Actually, I showed you that trade going away from this. And where did we stop? The RGL in the background. We stopped at the RGL. Managed to make a lot of money. Perfect, isn't it? But when does this market change? Well, there's the last liquidity level. So if that liquidity level breaks, bonds have just moved into a technical sell level, technical sell structure, a technical sell narrative. But until that price breaks, this market's still bullish. We haven't really changed anything yet. This liquidity at the moment is just liquidity. The last technical change of behavior was here. That was the last technical change of behavior right there. The market went bullish. But now this is liquidity. If we break that, we've still got to break that technical structure, because obviously if a small break of that's not really a technical break. Could still be a liquidity grab into this technical area, because this is the commercial buy zone now. So when we understand this process and then we add value to this, it makes a lot of sense. Now, talking of bonds, let's get through the reasons why I was buying and selling it. And this is a very, very important reason. We went through this in classroom about recognizing the belly flies. Why do we want to know about belly flies? Because they're massively profitable. In the world of trading, in the world of bond trading, you have three particular trades. You've got outright trades, which are done by prop. You've got curve trades, which are done by banks. And you've got fly trades, which are effectively arbitrage trades. They're not pure arbitrage. They are very, 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 very good statistical arbitrage because they are all linked to the same basic underlying market. It's not like trading oil against gas. They have different drivers. Well, 2-year yields have a different driver than 10-year yields, but they're still linked in a very formal way by being US Treasury risk-free bonds. So there's a lot more linking the 2s and the 30s than there is linking gas and oil prices. The only comparison that you could make with gas and oil, with the fly trade, for example, is things like the crack spread or the Brent oil WTI spreads. They are both the same, basically the same underlying product. In the crack spread's case, it is an underlying product. In the crush spread, it's an underlying product. The crush goes in and we get the product out, oil and meal. But they're more like curve trades because they're not arbitrage. We can have a crack spread that goes up and up and up and up. We can have a Brent oil WTI spread that has a good upside, not as much as the Brent. It's more of a rotational spread. But when it comes down to the fly trade, it's kind of unique in the world of trading. It's a very, very strong correlated product, but it's a very, 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 very big product for the banks because there's thousands of lots of liquidity on the 5s and the 10s. So the fly trade is actually, you can actually take it away from buying the belly and selling the wings. You can actually just buy and sell the belly, which is what a lot of banks end up doing. They turn a fly trade into an outright. And this is what I suggested to the guys in the room. If they have a desire to do those, you're only going to make $30, $60, $90 on these trades, but they're almost guaranteed that you'll make $30, $60, $90 on size because they have an incredible quality about them because the banks will automatically arbitrage those trades. They'll arbitrage them until the arbitrage doesn't exist. So when I see a trade like this, you might be able to spot it. The very obvious trade for me this morning was this sell trade right here. During this phase here, the 2s, 5s is going higher. When we started to see the belly going higher, the 2s, 5s going higher, and then we started to see the knob spread going higher, I've got to be careful because that's called a parallel shift. If that's a parallel shift, the bond price will keep going low. When does a parallel shift stop? When the parallel shift stops, it usually stops by a fly trade showing up because the curve starts humping in the middle. So if you want to stop the curve humping, sounds a bit rude, but if you want to stop the curve from humping, you sell it. You start selling that high on the fight because now the 2s, 5s is dropping. The knob spread is actually, not really moving very far. There's a macro sell in the knob spread anyway. So that's the trade right there. That's the sell trade on the fight. Well, if I know that's the sell trade on the fight, I know that's going to be a buy trade in bonds because it's going to get arbitraged. It is almost pure arbitrage. If we know it's almost pure arbitrage, if I can get that buy trade, I should be able to make some money very easily. And that was my first buy trade in bonds this morning. Boom, straight off the bottom edge. Bottom ticked it. As the price dropped down again, we actually had a little fight trade that dropped down too far. They pushed the fight trade too far, guys. Now, what? They pushed the fight trade too far? Yep, they sold into the high price here. The fight trade was at 5 3/4. And by the time they pushed it too far here, it was down at 2s. You might be saying, wow, 5 3/4 down to 2s. That's a terrible, terrible trade, right? Not really. That's 3 3/4 points on an arbitrage. 3 3/4 points on an arbitrage. That's $100. Bearing in mind that the banks can get 1,000 contracts on that spread. That's a $100,000 winner for the bank for almost zero risk. Almost zero risk. Who doesn't like that? That's a $100 profit for somebody that wanted to do that trade from the retail space. Who doesn't want $100 for almost nothing? He hardly moved. Still made $100. Anyway, so that one went too far. This pushback went a little bit too far from my liking, so there was a buyable opportunity in here. Then the belly ends up in the middle. The belly ends up in the middle. What happened when I exited my bond? What happened when I exited my bond? You might be saying, is that not a buy on the belly? Yes, it is. That is a buy on the belly. Absolutely. What happened to the belly? Well, the belly went beautifully, guys. The buy on the belly here went from 0 to a high price of 3 3/4. Another 3 1/4, another 3 3/4 points, another $100 winner for the fly trade. Now, this didn't reverse the bond. This didn't actually reverse the bond because the 2s, 5s kept dropping, and what's happened is the knob spread improved, which is why the bond didn't reverse off of that one. So I was obviously watching for this top edge anyway, so I wasn't that bothered about it. But what I did see was the belly came back down, but now the 2s, 5s is dropping. We're seeing some normalization of the curve. So this isn't really a curve trade anymore. So what is it? What is it then? Well, we could obviously look at the Japanese yen to see what it is. We could see at the bottom edge there was a brilliant buy trade here. The top edge here there was a fantastic sell. Into the top edge here there was a good excuse to be exiting my position. And at the moment I don't really want to be buying bonds. I want to be selling pullbacks. So I'm more inclined to be looking at that sell pullback trade there. That's the trade I want to be on based on the J's. What about the inflation break-evens? Oopsies, let's get the inflation break-evens. What would you rather be in the inflation break-evens, a buy or a sell? Well, at the inflation break-evens, I would rather be selling the top edge at that stage because that's what happened. We got a very, very nice inflation break-even away from that price, didn't we? Sorry, guys, just coming into numbers. Losing track of time here. See what the number comes out at. Quite an unusual number, wasn't it? That really was a disappointing number. Average earnings went up, but the headline of 194 obviously has caught the market a little bit by surprise there, but you can see what's happened. Inflation break-evens are still very bearish here, so selling those higher highs made an awful lot of sense on the numbers themselves because of inflation break-evens, I think. Anyway, welcome in, guys. Equities have started to sell off the bad news. You can see equities have came up to this price level and got a real seller coming in from that number there. Interesting, because obviously that's not a good number. It's inflationary because of the earnings numbers, and the unemployment rate did drop down to 4.8%, suggesting an awful lot of people dropping out of the participation process. So because a lot of people are dropping out the participation process, what does that mean? They're going onto the black market, aren't they? A lot of people doing a lot of business on cash basis only, and that's it. Anyway, sell side bonds still working hard, making a lot of money on the short side of bonds if you were still working on the short side, guys. I'm going to grab some lunch, guys, and I'll be back once these numbers settle down, and we'll see how we get on with the next phase of the market. Anyway, welcome in, guys. I hope you're all good this morning.